Ladies and gentlemen, good day and welcome to the Arman Financial Services Limited Q3 FY2026 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I would now hand the conference over to Mr. Alok Patel, Joint Managing Director from Arman Financial Services Limited. Thank you, and over to you, sir.
Thank you so much, Muskan, and have a very good afternoon to everybody. Thank you for joining us today. On behalf of Arman Financial Services Limited, I extend a very warm welcome to all of you to our Q3 and 9-month ended FY26 earnings call. I am joined by our newest Executive Director and Group CFO, Mr. Vivek Modi, and the Investor Relations team from SGA. I trust all of you had the opportunity to review our results, the investor presentation, and the press release, which are all available on the stock exchanges and our company website. Hopefully, also I'm audible to everybody because we are working on some new hardware here. So, Muskan, please interrupt me if there's any problem with hearing me.
Yes, sir.
Before I move on to the business performance, I would like to highlight important leadership transition at Arman. Mr. Jayendra Patel, the founder of Arman, has transitioned from the role of Vice Chairman and Managing Director and now will continue as the whole-time Director. He wrote a letter explaining his decision to the shareholders, which is definitely a good read. In this new capacity, he will remain closely associated with the company and actively engage with the board and senior management in providing strategic guidance, mentoring the leadership team, and ensuring a smooth transition with continuity and stability. For better or for worse, now I step into the role of Vice Chairman and Managing Director, of course pending shareholder approval. I've had the privilege of being with the company for over 16 years now. Tried my best to learn everything from the bottom up. I deeply value the trust placed in me by the board and remain committed to carrying forward our legacy while steering Arman into the next phase of long-term value-driven growth. I'm also pleased to share that Mr. Vivek Modi has been appointed as Executive Director, again pending shareholder approval, in addition to continuing as the Group CFO. Vivek has been with the company for the past 8 years, and in his new role, he will help execute the strategic goals of the company. His financial discipline and structured approach will continue to strengthen our institutional framework as we enter the next phase of growth. We congratulate Vivek on his new role and wish him best of luck on his added responsibilities. For sure, he will need it. Moving on to the business performance, the past 1.5 years has had its own share of challenges, which I have discussed in excruciating details over the past 4 to 5 calls. The industry had to navigate a series of events, including over-leveraging, low growth in real incomes in the rural household, changing JLG culture, regulatory uncertainties, regional political developments, and broader macroeconomic pressures. While these factors created short-term uncertainty and affected industry sentiment, it also pushed the MFI companies to become more disciplined, risk-focused, and structurally stronger. During this period, MFI tightened underwriting standards, strengthened monitoring mechanisms, and recovery processes. In many ways, this period helped the sector build a stronger systems and operate with greater prudence. I'm happy to say that the industry continues to learn from every crisis and pushes forward. Notably, much of that uncertainty has now eased. Now we are seeing clean, broad-based recovery taking shape. Repayment behavior has improved across key geographies, collection efficiencies are much stronger, and fresh delinquencies have moderated to a great extent. Borrower cash flows on the ground remain subdued, but our systems have evolved to better assess household cash flows, and demand across our business segment is showing healthy, sustainable traction. At Arman too, we took a step back, assessed the situation carefully, and focused on getting the fundamentals right again. Over the past few quarters, we tightened our underwriting, strengthened our recovery processes, and enhanced monitoring across verticals. One important step we took was clearly separating the underwriting and recovery teams. This has brought better accountability, sharper credit decisions at the time of disbursement, and more focused follow-up on collections. This structure is now in place across a majority of our branches, and we're already seeing the benefits in terms of more stable portfolio behavior and stronger execution on the ground. As a result, our business performance has strengthened. Our consolidated AUM stood at 2,274 crores, registering a sequential growth of almost 7%, reflecting improving demand and calibrated disbursements. Disbursement momentum gathered pace across segments, with consolidated disbursements reaching 612 crores during the quarter, compared to 475 crores in Q2 FY26, marking a strong 30% sequential growth in disbursements. This growth has been supported by sharper credit screening at the loan officer level and improved confidence on collections. Q4 seems to be shaping up even better. On the financial front, gross total income for the quarter stood at 160 crores, remaining largely stable on a sequential basis. Gross total income for 9-month FY26 stood at 470 crores. Pre-provisioning operating profit, PPOP, stood at 55 crores in Q3 FY26 and 166 crores for 9-month ended FY26, reflecting steady operating performance even as we continue to invest in people and technology, strengthen our systems, and building long-term capabilities. We are improving on-ground conditions and stronger repayment discipline. Impairment costs have moderated consistently over the past few quarters, declining from 76 crores in Q3 FY25 to 26 crores in Q3 FY26. This reduction reflects the benefits of tighter underwriting standards, better early-stage controls, and sustained focus on collections. As a result, profitability has improved. While sequential growth may not always be the most appropriate metric to assess profitability, profit after tax for Q3 FY26 stood at 22 crores, registering a sequential increase of 177%. For 9 months FY26, profit after taxes stood at 16 crores. This improvement, in our view, is a strong indicator of the broader normalizations, largely by our MFI business and other operating trends. Asset quality trends have also strengthened. GNPA as of December 2025 stood at 3.4%, improving from 4.13% in Q3 FY25 and 3.69% in Q2 FY26, while NNPA stood at 0.77%. Early delinquency indicators are also moving in the right direction, with PAR 30-90 bucket showing sequential improvement, particularly in the microfinance segment. Collection continues to show steady improvements, supported by tighter monitoring mechanisms and disciplined field execution. Collection efficiencies improved to 96.3% in December compared to 96% in September 2025, reflecting strengthening borrower behavior and sustained recovery momentum. Operationally, we added 15 new branches this quarter, taking our total branch count to 524, while remaining focused on strengthening our presence in core geographies. On the liquidity and capital front, the board has approved raising up to 500 crores through NCDs on a private placement basis, providing us with additional financial flexibility to support future growth. During the quarter, we also raised 522 crore of debt, further strengthening our balance sheet. We remain very well capitalized with capital adequacy ratio of 38.3% for the standalone entity Arman and 52.3% for the subsidiary Number Finance. Both very comfortable and well above regulatory requirements. In addition, our liquidity position remains healthy with 247 crores in cash and bank balances, liquid investments, undrawn CC limits, which ensures adequate headroom to support business expansion. Now moving on to the subsidiary Number Finance, which is where the MFI portfolio is kept. Our MFI portfolio grew by 7.3% sequentially to 1,618 crores, supported by strong disbursements of 455 crore during Q3 FY26. We are seeing strong traction in the new individual loan portfolio, which now stands at 285 crores. While growth has resumed, we have remained measured in our approach, ensuring that expansion is supported by disciplined underwriting and strong risk controls, especially in the current operating environment. Gross total income for Q3 FY26 stood at 107 crores, while for 9 months FY26 it stood at 316 crores. Pre-provisioning operating profit for the quarter was 35 crores, reflecting a sequential decline of 2.2%. For 9 months FY26, PPOP stood at rupees 102 crores. PPOP should also start improving once AUM starts increasing and generating more interest income. Importantly, we returned to profitability for Number this quarter after 4 consecutive quarters of losses, with profit after tax standing at 13 crores. For the 9-month period, we continue to report a loss of 16 crores as we steadily work through the stress seen in the earlier in the year. Our net interest margins have also begun to improve, with Q3 FY26 margins at 14.77%. This is driven by 2 factors: our ability to raise borrowing at competitive rates and new portfolio being built at healthier yield levels. Asset quality trends continue to move in the right direction. GNPA stood at 3.4% and NNPA at 0.66%, reflecting improving portfolio stability. Collections have strengthened on month-to-month basis, with December collection efficiency at 96.4% and ex-bucket collections of 99.3% in the MFI book. Early trends for January and February also indicate continued improvements. As of December 2025, 82% of our MFI portfolio is covered under the CGFMU scheme, providing an additional layer of risk protection and balance sheet comfort. Overall, we believe we are past the most challenging phase and now on a steady path of recovery with improving fundamentals, stronger controls, and renewed confidence across the portfolio. Now moving on to the standalone Arman business. During the quarter, we have piloted a new product offering solar loans. This initiative, started in November, is aimed at supporting households and small businesses in adopting clean and sustainable energy solutions. The product carries an average ticket size of about 2 lakhs and has been rolled out in selected areas across Gujarat. The initial response has been encouraging. As of December 2025, we have disbursed approximately 56 lakhs under this portfolio in 2 months. The product has a loan tenure ranging from 12 to 60 months with an average tenure of approximately 30 months, offering a balanced mix of profitability and manageable repayment structure. Beyond this, our non-MFI portfolio continues to witness strong traction. Disbursements during the quarter stood at 163 crores, comprising of 115 crores in the MSME book, 32 crores in the two-wheeler book, and 16 crores in the micro LAP book. Our EUM stood at 657 crores, registering a year-on-year growth of 28%, with 74% of this portfolio in the MSME book now. We continue to see healthy demand across these segments, supported by disciplined underwriting and improving on-ground confidence. For Q3 FY26, gross total income stood at 54 crores, registering a growth of 20.2% quarter-on-quarter and 3.6% year-on-year. For the 9-month ended FY26, gross total income grew by 20.2% year-on-year to 157 crores. Pre-provisioning operating profit or PPOP for Q3 FY26 stood at 19 crores. For the 9-month FY26, PPOP stood at 40 crores, reflecting largely stable performance on a year-on-year basis, despite significant headwinds. Profit after tax for the quarter stood at 9.4 crores, marking a sequential growth of 5.4%. For the 9-month FY26, tax stood at 31 crores, registering a modest growth of 1% year-on-year. Asset quality improved sequentially across our standalone portfolio. As of December 25, GNPA for MSME stood at 3.74%, for the LAP book at 0.31%, and for the two-wheeler segment at 4.28%. Collections have also strengthened across these segments. In December 2025, collection efficiency of the MSME portfolio stood at about 96%, while the two-wheeler portfolio reported collection efficiency of 95.6%, reflecting stable repayment behavior and disciplined follow-up. Largely, as the environment continues to improve, we remain focused on building a stronger and more resilient company. With disciplined growth, prudent risk management, and committed team on the ground, we are confident of delivering sustainable performance in the quarters ahead. With that, I believe we can now open the floor for questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we wait for a moment while the question queue assembles. The first question is from the line of Karthik Srinivas from Unifi Mutual Fund. Please go ahead.
Thank you so much. Congratulations, team, for the good set of numbers and the organizational change. So I had 2 or 3 questions. One being, what will be the percentage of the loan book that would represent the loans raised in FY26 now, sir? What will be the percentage of the loan book that represents FY26, the loans that have been raised in FY26?
The loans that we have given out, how much of the AUM will contribute to loans that were dispersed in 26? Is that the question? Did I get that right?
Yeah, FY26. Yeah, right.
Do you have that number?
So it will not be readily available, Karthik, but generally, if I could give a good guesstimate, it will be somewhere between about 70%.
Yeah, 65-70% would be a good guess also from me. We can pull that number out and
Sure. Sir, when you just mentioned about the collection efficiency, 96.4% for MFI, so while the peers have reported collection efficiencies of 90% and above, what would be the difference in the calculation, sir? How do we compute vis-a-vis the collection efficiency? How do we understand the collection efficiency in right metric, or how do we compare it? So that's the question.
So that's a good question. So there are 2 kinds of collection efficiencies which are reported. So one is typically called a zero bucket collection efficiency, or other is the overall total across all buckets. So the number that you are most likely seeing is the X bucket or the zero bucket collection efficiency, for which ours is about 99.3%.
Got it, sir. Sure. Understood, sir. Now, and so if I may ask one question, what are the key changes to your over-leveraging episode versus vis-a-vis as it is now, and see it going forward? So as our EVL model strengthened, how have we strengthened our EVL model to accommodate such kind of shocks? So what will be the key parameters that have changed in your ECL model?
In the ECL model, you are saying?
Yeah, right. In your assumptions,
all we can do is provide more management overlay. Our ECL model is evaluated semi-annually, and whatever needs to change in that is the problem. I mean, once a account goes into 1+ DPD, that's when the ECL model kicks in, and then obviously there is some bit of provisioning which is there on the zero bucket as well.
In addition, if I can add.
Yeah.
So in 24-25, when you really saw the asset quality duration, ECL is one way of ensuring covering yourself up for probable future losses. But as a strategy, it was also important for us to ensure that at a sector level, if the stress continues, then how do we safeguard ourselves? And that's wherein you're probably one of the few who took the leap forward and started subscribing to the CGFMU coverage. And as Alok, during his opening remarks, commented that we already have 82% of our microfinance book in Namra being covered under the CGFMU cover, which kind of came into existence since October 2024.
Right. So I think that's an excellent point, Vivek. So, provisioning, I know a lot of people put a lot of emphasis on the provisioning figure, but I mean, from a non-accounting standpoint aside, only thing the provisioning helps is to up incomes. It's just a balance sheet figure. So, I mean, yeah, I guess that provides comfort to some people, but, like having adequate liquidity, sufficient capital available, and other factors play a lot bigger part for companies to get out of any jam that they find themselves in during a down cycle. So CGFMU was definitely one of those calls where if there was a way to, sort of hedge away the risk by paying some premium, I think it was a no-brainer, and that's what we jumped into, and that is basically the insurance policy available to us today in case something drastically goes wrong again in a short period of time.
So, just a follow-up question. So, in that case, will your provision PCRs come down now that your 82% of your book is now covered by the scheme?
Yes, you're right. Because, you're paying for the default guarantee cover, and you're covered for every 100 rupee that you kind of take a coverage for. The default guarantee cover applies to about 75% of it.
Right.
So the provisioning requirement to that extent will come down.
Right. So in some ways, the OPEX would increase because you are paying for the cover, and subsequently your provisioning might decrease to the percentage that cover is guaranteed for those particular assets which are in default.
Got it, sir. And last question is on the growth rate. So now that the entire sector is on a steady state, like coming out of the woods. So just talking about growth rate, how do you see, sir, now that the number of lenders is capped and then you have a high rejection ratio? So going forward, what will be the strategy to grow then? So would you have to seek more and more penetration, or would you have to give how do you grow then? So in terms of your strategy.
For the growth, see, there are a couple of things here. So first of all, let me say that hopefully people like myself and the industry has learned enough lessons where just because the market is improving, we don't really go into not just unreasonable growth. You can grow fine, but not just put growth ahead of whatever the lessons that were learned during these crises, right? People have a tendency to sort of forgive and forget and move on after a couple of years. And so my fear is that is exactly what's going to happen again. And hopefully that does not happen. So whatever growth comes in has to be calibrated. It has to be well thought out. But to answer your specific question, you are right. As far as JLG and things are concerned, the culture is diluted. You are restricted with underwriting and everything. You are restricted in terms of number of MFIs and total leveraging and other factors. And so, honestly, as a company, we have already started to redefine of what is microfinance, right? Because it's not just the JLG model. That might be a model that is there and it still is a substantial part of your books. But I personally feel that the future is in product innovation and better underwriting. If we are able to assess the customer better, and that's what we are trying to do with the BCM model, that's what we are trying to do with technology, with new algorithms and stuff that we are starting soon. That if we can assess the customer better, we don't need them in a group. We can service them individually. And we have been doing that in the MSME book as well for many, many years successfully, perhaps even more successfully than the JLG model. So I believe that the next phase of growth is going to come with innovating the product structure itself. So we are not saying reinvent the wheel and find new customers, but the segment that you are servicing, can you evaluate them better and service them with different products, basically?
Sure, sir. Thanks so much. That's it. All the very best.
Thank you. The next question is from the line of Rudrak Raheja from iThought Financial Consulting. Please go ahead.
Yeah, thank you for the opportunity, sir. Am I audible?
So can you speak a little louder, please?
Yeah. Am I audible?
Little more, sir. We can't hear you properly.
Yeah. I wanted to check, sir, what kind of growth rates would we be comfortable now the industry books has all been cleaned up and all of that?
That's an interesting question, and that's probably one that I also struggle with. Is there a growth rate that we can target, or should the growth come naturally as a function of all the changes and all that you are trying to do? So, I would say in FY27, roughly speaking, I would be comfortable growing maybe 25%, just throwing a figure in the air. But I think we are going to stop doing those kinds of things that, okay, we want to grow at 40% and what do we need to get there? I think it needs to be a function of many, many different things, and the growth figure has to be reverse engineered in that perspective. So usually right after a crisis, there are short-term opportunities available. Typically, we have advantage of. So you might see a sort of strong growth in the last quarter of this year, for example, when a lot of the MFIs are still kind of coming out of crisis, working through liquidity issues, leadership issues, and other things. So that creates sort of a temporary vacuum where we can sort of take over market share. And then typically that slows down, right? So I don't have an exact growth percent to give you. Certainly, I don't think we can expect growth out of the industry that we have. The market has been historically been used to, very honestly. But that said, I think FY27 you can expect at least a 25% growth.
Understood, sir. Understood. And sir, would it be fair to assume that a non-MFI book would grow at a much higher rate than MFI book going forward?
I would say the non-JLG will grow much, much faster, whether that is in the subsidiary Namra or in the standalone Arman through MSME LAP and two-wheeler loans. So, yes, I would say JLG will be a lot slower to grow, or even, I dare say, grow, and while these other products will continue to grow faster.
Understood. And sir, for business going forward, what level of debt to equity would we be comfortable before getting into the market and raising more equity and diluting? So what is the peak debt to equity that we foresee?
We are usually comfortable at about 4.5x, which we are.
I mean, quite a distance from this. Right now, our debt equity is less than 2, in fact, less than 1.5 for that matter.
Yeah.
But having said that, I mean, with the new normal, in the first milestone would be to reach a debt equity of at least 3.5. And looking at the overall how market behaves, we might have to go forward. And largely we can say that at an organizational level, group level, till a AUM size of about 5,000, I think we should be comfortable with a capital adequacy of upwards of 25%. So largely not really seeing that as a challenge in a 12.
Understood, sir. And last question, sir, from my side. Would we be stepping up disbursements a lot on the MSME book now, or we will be focusing more on more new products like one you mentioned this quarter we have done a pilot on solar goods, etc. So what is going to be focused on non-MFI side?
No, I mean, there are no options here for sure. If I can grow the MSME book a lot faster, sure, I'll take the opportunity to do that. But that product has always been sort of slow and steady kind of a growth for us, and that has worked very well for us during both COVID and whatever you call this new crisis. So, I would rather not take my chances. I've been lucky with that product for the past many, many years. So I think the growth rate in the MSME book should be similar to whatever you have seen in the past 3-4 years.
Understood, sir. Thanks a lot.
Thank you. The next question is from the line of Ronak Chheda from Omega Capital Advisors LLP. Please go ahead.
Yeah, hi, am I audible?
Yes.
Hi, Alok. Congratulations on the disbursement growth. I have two questions. One is on the pilots which we were running, especially on say lab products, etc. Just wanted to check on the progress. Have we met internal benchmarks for to kind of now see a significant scale up on these products? In your past answers, you really mentioned about adding more products. So what is the status there? And will we use Namra's distribution kind of, to go ahead and ramp up this product significantly?
Yeah, so definitely the lab is doing reasonably well. Little bit of sort of fear, which is a good fear in the micro lab and the affordable housing space, obviously there are murmurs of something of quality-related issues that may or may not happen in the short term. But, we are steadily growing. I think, Vivek, what are we now? About 6.5 crore disbursement on the lab, and growing about, probably 5 to 10% every month. And so, as far as we are concerned, we are on schedule for whatever we had envisaged for it. But I'm very cautious about blowing anything up. So we'll continue with that slow and steady approach, and we'll see. As far as performance goes, we are facing no significant so far in the lab book. Lab portfolio is about close to 90 crores now. Close to 90 crores is the lab.
I think we are out of that project phase, because today we're kind of doing it across at least 3 states. And as we move into UP, north in terms of UP, even, that way we can clearly say that it's definitely not a project phase, and we're looking at scaling it up in all these geographies where we're comfortable with.
Right. And so as far as some of the other pilots, I think we had mentioned we started in November the rooftop solar financing. And again, that's just probably an experiment and also a limited opportunity in the market, because there are, government subsidies available directly to the customers. So it has become a very popular option. But what we found is that most of the marketing is being done in the urban, metropolitan cities and tier 1 cities. I don't think that reach has developed in the rural yet for these rooftop solars, and arguably they probably need it more than the urban people, So, we have started this pilot. Let's see where it goes. We have done very small volume so far, only about 56 lakhs. The goal is in this quarter to reach about 1 crore of disbursement monthly by March, hopefully. So we'll keep you posted on that.
My question was more on lab. Given that it's at a critical size, can this go to like 500 crores where our MSME book is over the next 2-3 years, given that if the internal benchmarks are met, you just roll it out across your different geographies where you already are doing unsecured. So the question was more on the lab side.
It's possible. It's definitely possible even going past that, because the lab ticket sizes are larger and the stickiness is higher as well, because the the tenure is higher. But these are not, honestly speaking, from my perspective, you have to take a balanced approach, because LAP does not, the OPEX is low in LAP as well, so let's not compare it to MSME, but the margins are also lower in the secured book. So it's just not a matter of being secured or unsecured. I think you have to take a calibrated approach. Over 2-3 years, I think it's definitely possible for it to even surpass the MSME portfolio for the reasons which I said. But I won't really feel comfortable making long-term predictions at this point.
Yeah. And second question is on MFI. So given that the guardrails are in place now, a lot of the borrowers who may have defaulted in the last cycle are already out of the system. So just wanted to check on the on-ground credit growth demand. And is that aggressive enough for us to step up on disbursement? Is there enough growth? And the second part is, are the fintechs, etc., which were active in the last cycle still relevant as competition, or you seeing some of the competition with various products, exiting the market, and there are a handful of players now catering to this demand? So just wanted to check on this front.
Yeah, so to answer your second question first, definitely there are a lot fewer players serving the same customers as we were today than they were, let's say, about 2 years ago or something. So, yeah, I would say, again, I don't have any numbers to back it up. This is just the feedback which I received from operations team, that definitely their overall presence in the markets that we are servicing is significantly lower, number one. Your first question was, remind me again, what was your first question? About the growth and yeah. So that is, again, we struggle with these kinds of questions very often as well, that, during COVID, you had a significant serviceable population drop out because of defaults. During this cycle, you have another significant portion. So the market is becoming, from a client perspective, is becoming smaller and smaller, because for most MFIs, being a past defaulter is an auto reject, right? I mean, no human eye has to even look at it. The system will automatically reject the customer. And so over the long run, what do we do with these customers? I don't know. It's really it's a valid question that the industry needs to get together and try to figure out, that if we keep removing customers who have ever defaulted from the overall pool of potential customers you have, that in and of itself is a problem. But on the other hand, nobody's going to really risk giving loans to customers who had higher defaults, right? So that is one aspect of it, and that is something that we face on a day-to-day basis. That is what pushes up our rejection rate significantly as well. So you were asking about inquiries. So the inquiries have increased. The rejection rate has improved slightly by 2-3%, where it was, let's say, about 80% earlier. Now it is closer to 77%. So it's improved slightly, and the inquiries have also increased over the last 2 to 3 months. I think our staff is now better trained or have better experience that which customers will have a higher chance of getting approved. And so that is what the pipeline gets pushed into the system as well. But there are a lot of contributing factors that would, determine how much we can and cannot disperse. Obviously, past default is a huge issue that the industry would have to solve in the next year or two.
And my last question is on your recoveries. Given that now the disbursement
Can I request you to rejoin the queue for the follow-up question?
Sure. I'll come back in the queue. Thank you so much for answering my questions.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit a question to 2 questions per participant. Do you have a follow-up question? We request you to rejoin the queue. The next question is from the line of Chinmay Nema from Prescient Capital Investments. Please go ahead.
Hi, sir. Hope I'm audible.
Yes, a little louder if you can, please.
Sure, sir. Sir, just wanted a little better understanding of the trend in PAR on the microfinance side. So, one, if you could explain what has led to such a sharp decline in the 30 to 90 book in the last 2 quarters. So, have the collections been better, or have the fresh inflows have been significantly lower? And secondly, the same trend is not visible on the 90 plus book, which I believe is a book on which you would have had all the write-offs. So, if you could explain that as well.
Yeah, so, it's the reduction in PAR figures is at the expense of overusing this, a function of many different things. So, first of all, whatever pain points we saw were essentially disbursements made prior to March 2024. So, and typically when you work with a 24-month cycle in the MFI pool, long story short, either those customers have mostly repaid you back, or they have defaulted and we have written them off or are provided for and are already at 90 plus. Whatever new pool was created post September or November that we are tracking closely with new underwriting standards, with guardrails in place, with very, very calibrated kind of disbursements, we were looking at their performance and following up on their performance in terms of quality basis very, very closely. So the reduction is largely replacing bad customers with good customers. That's number one. That's probably 80% of the reason. The 20% is probably slightly better macroeconomics and better collection team on the ground level. Vivek, anything to add? I don't know.
Again, just from a more statistical point of view, because you would have seen that the X bucket collection efficiency or the zero bucket collection efficiencies have been constantly improving in the sector and also for Namra, which automatically means the slippage ratios into the 90 to 30 will, in a phased manner come down, because when the trouble was at the peak in, let's say, quarter 2 of the last fiscal, then the collection, the zero bucket collection efficiencies have come down to as low as 97.5 or something. And today, if they're upwards of 99, that clearly means that you're adding so many less defaulters every month.
Correct. Yeah, so that's also a very interesting point. So, right, the zero DPDs is something that in the MFI pool you follow very closely. Usually speaking, again, this is a very rough statistic, but a customer who goes into 1+ bucket, depending on what crisis it is, whether it's COVID or demon or others, there's about a 30 to 50% chance case, or 30 to 40% chance that they will eventually write them off, right? So they'll keep going into different buckets, into 30, 60, 60, 90. So the idea is that you don't want things to slip into even 1+ bucket, because then the probabilities are very high that eventually you'll have to provide for them and write them off completely. So yeah, that has come down significantly as well, and for reasons which I just explained to you.
Sure, sir. Understood. Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Yeah, hi sir. Good afternoon, and thank you for giving the opportunity. So, sir, first question is on your OPEX. So for 9 months, we can see that the OPEX in absolute terms has increased by around 40 odd crores, and around 17-18 crore is being contributed by the MFI business. So I'm guessing some part of it is related to the premiums that you might have paid. But if you can explain, what has led to this sort of an increase in the OPEX and how we should look at OPEX ratios going forward.
Yeah, so OPEX has definitely increased. There is no denying it. I've covered this in previous calls as well, but largely we added the whole DCM structure, which is expensive. We separated operations completely from credit, and so that adds to the OPEX. We have a big recovery team which is in place, which is collecting a good bit of money that otherwise would have gone into NPAs and provisioning and write-offs. So definitely we are getting more value from them than what we are spending at this point for sure. But that has also increased the overall OPEX related to employee costs. And as you mentioned, the CGFMU, we have paid 7 crore this year on CGF. So that has also... there is honestly the only way to... I don't think it's going to be possible. All we can do is that at the existing level, will increase the portfolio and therefore the interest income that you are earning as portfolio, and that will increase the PPOP. But I don't think it is a good strategy today to about reducing that absolute number of OPEX, but certainly from a percentage standpoint, it will slowly start coming down.
But even in the standalone piece, I think the OPEX has increased by almost 50%. So MFI, we understand collection teams and credit structure and premiums. But in a standalone, what has contributed to this high OPEX?
Standalone, you're talking of Arman?
Yes.
Okay. So standalone Arman, we kind of added team on the lab, and there has been expansion of the Arman team itself into states like UP, Uttarakhand. Yeah. Additionally, expansion basically. So it's basically expansion, and then we've added this entire, solar energy or green energy team. So it's not a very, very large team, but still, that's something that has come up in the quarter 3 itself.
No, I think if you look at it, we have opened new branches, we have opened new divisions, employee costs are going up just like many other companies in all over India. So I don't have any better explanation than that.
And additionally, also to address, while this number in absolute terms may not be very high, because two-wheeler itself is not a very big portfolio. It's just about less than 10% or around 10% for the standalone. But quarter 3 is the highest performance quarter for the two-wheeler, and that's where the expense also kind of peaks for the thing.
Yeah, I think he's talking about the 9 months.
Yeah. So kind of both 9 months and 9 months. Yeah.
And where should it settle, sir? Where are your OPEX ratios going to settle? If you can give some guidance on that.
I would love for them to at about 4.5. Well, for micro console level, let's say about probably 4.5 to 5, about 5% of total AUM. Typically, I think the good new target to see.
Okay. And sir, this quarter, I think last quarter we felt that, you are slowing down a little bit on the MSME piece and increasing other product segments more than MSME. But this quarter, I think again we have seen a sharp increase in the MSME disbursements vis-a-vis other products.
So I think we are slowing down on MSME. Is that what you are saying?
No, so last quarter, I think going by the commentary, it looked like, you are relatively preferring other products which are lower yielding products within your standalone business. But this quarter, I think again MSME has grown the most in the disbursements. So has there been any change there?
Let's first kind of address the first quarter. Misunderstood or we have never kind of wanting to slow down our unsecured assets. Yeah. Last quarter, in fact, we started or ramped up our branch network in newer states as well. So maybe,
I say a lot of things. Sometimes I don't remember it.
So it was probably
I have said it in a context that I don't remember. But no, my intent was never to slow down MSF. So let me very well.
Okay, sir. Thank you and all the best.
Thank you. The next question is from the line of Srinivas V. from Bellwether. Please go ahead.
Hi, Alok. Just wanted to take forward from Ronak's question on loan against property. So what we are kind of looking for is a slightly more nuanced and detailed understanding of how do you plan to roll out this product, and what kind of, customer occupancies have, seen joy in or cohorts where, it's worked out well. And if you can share, between the three markets, how has been behavioral pattern. And one of the issues in this particular product has been that there's been some level of over-leveraging at the end client. And, what are your thoughts on that? And how have you built a credit process to kind of keep a check? Because if the customer's not been that over-leveraged, the collections in these products are phenomenal. So generally want to get a perspective of how you're seeing this product and its nuances over like a 3-year window.
So let me tell you that the NPAs in this segment are pretty much very, very low at this point. I think it's only 30 bits. So I don't have enough data to develop that nuance. Is one occupation better than other? Is one region better than other? I have not noticed anything that you can, from at least from the BI perspective, we track all of these things, but nothing really has emerged as more or less risky in terms of LAP. Now, we are rolling them out in our MSME branches, which are located in Gujarat, MP, Rajasthan, Telangana, and Maharashtra we are not rolling out, but obviously we have in Maharashtra as well. So far we have rolled them out in MP, Telangana, and Gujarat. We have not rolled them out in Rajasthan yet.
Not even in Rajasthan that way, but very few cases we might have tried there just to get the flavor of the place. But
right.
But the major pie for the LAP portfolio, as we talk today, stands in Gujarat, which is more than 60% of the entire, and then Telangana, MP, and as we scale up, maybe UP might be also one of the larger.
Yeah, right. So in the MSME side, we are pushing our branches towards, and so that can be another place that we can start micro LAP in the UP market. Now, in terms of underwriting, you are absolutely right. I don't know so much about the LAP, but at least in the affordable housing, some players are better than others. Some are just considering something as secured and just not doing a lot of underwriting checks. And I mean, they are making sure that all of their loan agreements and mortgage deeds and everything are absolutely clean. But as far as assessing whether the customer can actually repay the loan, I don't think a lot of players, in my limited opinion, are doing a very, very good job. Just getting comfort from the fact that it's a secured product, And I believe that in the Indian context, it's very, very difficult to, repossess somebody's house, their primary residence, and so whether it's secured or unsecured, you have to make sure that the underwriting is, all the underwriting you do is, assuming that it's going to be very difficult to get comfort from the security itself. So we are doing everything that we can. I mean, obviously we are doing reasonably well income assessment and making sure that on the ground level, doing all kinds of checks that we possibly can. Income proofs are difficult to get in some of these segment markets, but in the event income proof is not available, our BCMs go in and make sure that they get a good guesstimate around it by supporting it. So, I don't know if that answers your question or not.
Yeah, perfect. So effectively, we have 120 MSME branches. So over a period of time, most of these branches will also service micro LAP. Would that be a fair understanding?
I would say most, not all for sure, but most would. Yes.
Got it. And these are separate teams completely sitting there, right? Because last time I checked, the credit appraisal team of the micro LAP is completely different. So it's basically one infrastructure housing two different teams.
It's one infrastructure housing two separate teams, but in many cases we are using, so there are two levels of BCMs that we have. The more senior BCM structure that we have can do the evaluation for both MSME and micro lab. And of course, there are other branches where it is separated also. So it just depends based on branch to branch nuances.
Got it. Just one last question is in MFI, we've had a credit officer in many of these branches. Just wanted to circle back. Even last time you had very encouraging feedback on this practice. How has been your, assessment of loans that have been dispersed post this particular, addition? And in those branches, have you particularly seen quality of book being better when there is a person kind of overlooking the specifics, so on and so forth?
Right. So and that's a great question. So on average, non-BCM originated customers post, let's say, November of 2024, compared to BCM originated cases post November 2024, there is almost a 50% difference in the default rates. So, but yes, the default rate is low as it is, So if let's say if it was non-BCM originated where, 2%, this is close to 1%. So there is a broad difference right now. Whether that carries forward during credit cycles is anybody's guess, because it's easy to say 50% when your default rates are low, but whether that same thing carries forward when the default rates are high, I don't know, and there's no way to know until you reach that, right? So, but I'm very bullish on it. And having DCMs, apart from reduction in overall credit cost, also serves another benefit in terms of culture and having the ability to introduce new products, right? So if you are just doing the same JLG, one could argue, well, given the cost and what you are saving, it might not be worthwhile to have DCM. But having BCMs, every new product that we introduce is always like, okay, this requires a lot more evaluation, it's a higher ticket size, it's something we haven't done. And so it allows us a lot more flexibility to be agile in terms of offering new products or changing our products.
Perfect. Congratulations. That sounds good, yeah. I'll get back into the question queue. Thanks a lot.
Thank you. The next question is from the line of Jay Prakash from Koman Capital Investment. Please go ahead.
Hi, sir. So my first question is on this provisioning and NNPA. So we've seen some rise in the NNPA from generally, I think your last 3 quarters were about 0.5, and now this has changed up to 0.8. So does it mean that you have confidence in terms of your GNPA accretion to be lower going forward, and that's why maybe you're not provided for, and you're comfortable with that kind of number?
Two things that have happened here over the last 1 year is given the overall market scenario, we've been slightly aggressive in our write-offs, and hence the on-balance sheet books. The average DPDs of the NPAs are far lower when you compare on a YOY basis, right? So that means something which sits at an average of, let's say, 180 DPD in my NPA book, vis-a-vis an average that would have been, let's say, 225 days. My NPA provisioning requirement based on the analysis will slightly come down, taper down. So to that extent, there is an improvement in the overall collection efficiencies and the quality of the NPA book.
Got it. And so just a follow-up, just a question on this. You said product innovation and new products, right? If you can give some more color around that side, like we see that solar financing as a new product launch, and can you provide some thoughts on new product launches in the foreseeable period?
So the individual loan portfolio in the microfinance number side is one such thing where I think, what is the book now of that? 285 crores, odd crores, yeah. So that is one part where we are using the BCMs to evaluate customers, almost similar to how we evaluate them in the MSME book, right? And we are focusing on, one of the main purposes of JLG was also the OPEX side, because we were doing doorstep collections. And so instead of going to one customer to collect at their doorstep, it's a lot easier to go to 5 and collect at their doorstep, right? So there was, apart from the risk mitigation part, there was a good case in terms of operating costs as well. So with these customers, we are targeting cashless. And I think until last month in this entire portfolio, I believe 75 to 80% of the money was coming through cashless mechanisms.
Which is primarily the UPI mandate.
UPI mandates or large mandates. So that is the pull model. We are not waiting for the customers to initiate a cashless payment, but we are directly pulling it out of their bank accounts. So as long as it remains that way, even if it maybe goes slightly lower, I'm very, very comfortable with the individual book. In fact, more so because we are doing a lot more underwriting. The only problem with individual that I had was, the OPEX side. But as long as it continues to perform well in cashless payments, I don't foresee much of an issue there. So that is the individual loan side. Other than that, obviously, we had started micro lab. We have talked in quite a bit of detail in this call about that. I won't get into that. Solar is just an experiment. I mean, I don't want to spend too much time talking about it. People who have been following the company knows that we do these occasional pilots and experiments. I think let's talk more about it in next quarter. It's really too early to kind of get into a lot of details about that.
Got it. Thank you.
Thank you. The next question is from the line of Shyam Sampath from MSA Capital Partners. Please go ahead.
Hello, sir. Good afternoon. I want to understand, firstly, on the MSME book, right? We had spoken about earlier with another participant how the book grew and it contributes a significant portion of the high-yield book. So, because this is a high-touch cash collection model, I wanted to understand, do the current branches and manpower infrastructure that we have, does it support further scaling of this vertical if required without diluting the underwriting standards?
The current so what you are asking is, can I push the portfolio higher without increasing operating cost? Is that
correct? Correct.
Yes?
Yeah.
Yes, but not by much. Maybe 10-20%. I take that back. I mean, we have a lot new branches. Yes. Maybe by about 20-25% for sure can be cash. We can scale up without increasing OPEX. Will we? I don't know. I mean, it's a continuous process. You've got to open branches, invest in people. The caseload of around 300 or something in the MSME, I have to hire another ICO. Once the branch reaches a certain portfolio, I have to get an assistant DM. Once the branch reaches a certain portfolio, I pull in the credit side instead of one. And then there's a whole support team above it. So, MFI, 100%, I can tell you that we can scale that up quite a bit before need to hire new people, at least in terms of portfolio and disbursement. Besides new branches, I'm not too sure.
Okay, sir. Understood. Sir, and the next question with regards to, in the presentation, we had mentioned that digital collections are now about 25%. And so I want to understand with that, are we analyzing the credit behavior of digital payers versus cash payers? And if in case we're doing that and if digital payers show a lower default rate, are we thinking of any differential pricing with lower interest rates to incentivize digital adoption?
Oh, that's a good question. So, I mean, at the origination stage, are that we cash payers and cashless because we encourage all customers to become cash. At origination, it's an interesting point we put there. We would have to look into that at that point. Right now, no, we are not distinguishing the cash payers versus cashless players. It's hard to tell them apart during the origination side. In terms of offering better rates to people who are paying cashless in further cycles, of course, I'm happy to do so because the operating cost would be much lower. I think if a customer is paying a significant their EMIs through cashless mechanisms, definitely we can pass on some.
Okay, sir, got it. So next I wanted to understand, you had mentioned there were commentary around like visible signs of normalization and credit behavior is improving, right? Like industry-wide. So given that our MFI GNP has moderated down to 3.4%, do you think that this is the bottom of the credit cost cycle that we're seeing, or in the coming quarters, can we expect more write-offs?
I'm not sure exactly how to answer that, Vivek. Would GNPAs continue to go down from this 3.5%? My judgment tells me that yes, definitely in Q4 it should go down further. But you are the accounting.
So primarily, if you can look at that, the GNPA plus 12-month trailing write-off, if you can put it that way as a figure, that definitely has been tapering downwards for the last 3 quarters, and we feel that this will continue to kind of keep coming down with the overall improvement in the sector, and also with the kind of checks and balances that we put into place through this would be probably expecting it to perform better than the market for a number of years.
But where the industry stands today, it would be hard for me to say we will ever go below 3%, for example. So, good cycles where you are growing very fast and due to the denominator effect, you under 3%. But it would be very say that it in the long run, on average, it will go below 3%. But happy to be proven wrong.
Okay, sir, got it. There was a slight disturbance, but I think I get the gist of what you're saying.
Sorry.
No worries, sir. No worries. Next, I wanted to understand, sir, around the MFI customers, we're down to about 5 lakhs and our disbursements are rising. So, is this because we are increasing the ticket size per borrower to drive growth, and do you see this as a risk of increasing delinquencies next FY?
So yes, I would say it would be hypocritical of me to not acknowledge the fact that the average ticket sizes have increased, especially not in the JLG products. I think in the JLG products they have decreased or are stagnant. But in the other products like the individual loans, they are obviously much higher. But that said, being a sort of a conservative kind of a guy myself, in terms of risk, I am not very uncomfortable, even despite the higher ticket sizes in the individual products. Because again, we are being very, very careful, very selective. To give you an example, in the individual product, all of our customers have like a credit score of 300 plus, and they all have credit history. So we are not really doing a lot of new to credit borrowers unless, the checks and balances around that are even much stronger. So it's just a different product, So I would be a lot more uncomfortable if the JLG ticket sizes are increasing. In this product, we are taking ample precautions, and still, I agree, it's still at an early stage to say whether it's less risky, more risky. But it seemed like the right strategic decision, and I still stand by that this was the right direction to go towards.
Okay, sir. Understood, sir. Sir, and on the
I heard on the Muskan, are we disconnected?
Yes, sir. The participant left the queue. So as that was the last question for the day, I would now hand the conference over to Mr. Alok Patel, Joint Managing Director, for closing comments. Over to you, sir.
Nothing much to add. I think nice long call. Thank everybody for being a part of this call, and hopefully answered all the questions to the best of our abilities. And if you need more information, please feel free to contact the investor relations team. Their contact is available in the presentations, and I appreciate everybody's time. Thank you very much.
Thank you. On behalf of Arman Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect the lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.